AIM-listed Trident Resources, soon to be renamed Trident Royalties, is a growth-focused, diversified mining, royalty, and streaming company listed here in London on the AIM market. It's recently listed to raise money to invest in the mining sector. It's done its first deal and is on the prowl for other possibilities. It does have a pipeline that we're going to be talking about now with the chief executive, Adam Davidson, who joined us on the line now from Denver. Adam, it's great to talk to you. We love the idea of talking about something not necessarily new in the mining sector, but certainly something perhaps possibly maybe to London investors, this idea of royalty and streaming. Just first of all, outline what it is, what the deal is, and what's the appeal for investors.
Yeah, sure. So, I mean, royalties, they're actually a pretty simple structure. So effectively, a royalty is in exchange for an upfront payment. The royalty holder then gets a percentage or a cut of the revenues of the underlying asset. So it's really that simple. And of course, you can make it as complicated as you want and have unlimited sort of permutations, but that's really it in a nutshell. So it gives a few sort of really key benefits to investors. If you're an investor that wants exposure to mining commodities, particularly in a market like this, getting exposure to sort of inflation hedged real assets can be appealing. Then the next question is, well, what miner do I pick to get that exposure? And the problem miners have investing directly versus investing in a royalty is that royalties, by sitting at the top line, they're not exposed to capital or operating costs. So you enjoy the benefits if the underlying miner of that asset that the royalty is over spends money to expand throughput or spends money on exploration and it increases the size of the resource. That all obviously will ultimately benefit revenue, which therefore benefits the royalty. But they're using equities money to do that expansion or to do that exploration. The royalty, once it's in place, you get that fixed percentage, and in most cases, it sits there forever. So it gives you that direct exposure to the underlying commodities and the exposure to the asset with the upside that comes with that, but without some of the pitfalls, I suppose, that equity have. Because I think many people have invested in miners only to be burned, when really all they want is the exposure to the underlying commodities.
Yeah, that's a story that many will align with. Look, I want to talk a little bit about why London, because the market for streaming and royalties, I think, if I'm right in saying, is really sort of a Canadian thing, isn't it? We don't know too much about this on the London markets. It's refreshing to see something new come along. And just explain why it's traditionally a Canadian thing and not London.
Yeah, so it's traditionally it's Canadian. Royalty financing largely grew out of North America and in the precious metal space. So, unsurprisingly, when you look at the peers in the royalty company universe at the moment, well, it is very, very heavily dominated by TSX listed companies and dominated by those that are precious metals, either exclusively or predominantly. So that's one point of differentiation for us. Is our intent when we looked at the space. That there are just a few that are not precious, exclusive, or focused. And of those, they each have their own unique sort of pitfalls or unique tack. And what we want to ultimately provide investors is, I can extol the virtues of royalties like I've just done and explain why they're a great way to get your commodity exposure. But then from there, the next natural question for a generalist or a retail investor is, I like royalties. I want that real asset exposure. So what do I buy to get it, on a broad, diversified basis that I get exposure to the full suite of mining commodities? And at the moment, that offering just isn't really out there. So our intent is, over time, to build a portfolio that's broadly reflective of the mining sector by commodity breakdown. So by that, I mean roughly a third precious metals exposure, a third base metals, and a third bulk minerals and battery and industrial and sort of everything else, which, depending what lens you're looking through, is roughly the breakdown of the mining sector. So that allows investors then to have a single share in Trident and get that full exposure to the suite of mining commodities, but obviously from a royalty perspective.
You're up against some big players. I mean, you're still quite a small company. What's the competition like? Is it difficult to get into? And are you up against some stiff competition when it comes to the companies you got your eye on in this pipeline we'll be talking about in just a minute? Does it not make it more difficult for you to show up with an offer that's appealing to the businesses you're trying to get a relationship with?
No, actually, I think that's part of the opportunity as well. When you look at the space, and it's interesting actually, if you rewind the clock sort of 10 or 15 years, there's currently 17 or 18 listed royalty companies, but going back there would have been 2 or 3. So despite the fact that some of those are many multi-billion market cap companies, it's still an industry that's somewhat in its adolescence. So there are sort of targets of opportunity that are still not covered by the space. So yes, if we were to go for a $50 million ticket to write a royalty on a Canadian gold asset, that would be an extremely competitive space, no doubt about it. But what's missed by a lot of the really large players, and obviously the precious focus of the industry, is some of those more attractive royalties on the smaller to mid-size assets, and obviously in non-precious, and then specifically when you get outside of North America. So our first royalty is a good example of that.
Now, let's take a look at the deal that you've already pocketed, this one in the iron ore space. Explain how that's been put together and what the rewards are for shareholders that buy in to Trident Resources.
Yeah, sure. So this is actually a good case study of the type of asset that we're looking for. So this was an existing royalty. It was a junior company on the ASX that had this royalty, and it was from sort of the previous 10 years of M&A when they used to hold this property. Sold it, retained a royalty, and then kind of put it in the bottom drawer. So it wasn't even present on their balance sheet. But then lo and behold, Mineral Resources, a multi-billion market cap miner in Australia, acquired the properties, started mining it, started ramping up production from 6.5 million tons a year throughput for the broader operation, up to 11 million tons, and have now allocated 120 million Aussie to continue that expansion up to 15 million tons. So when we looked at it, it was held by not a natural holder of the royalty, not for the long term. So the party was happy to monetize it, knowingly taking a haircut, but happy to monetize it to get the cash in the door because they have their core assets that they want to go explore and drill out. So they're happy to monetize it and aren't a natural holder. The assets in Australia, so a great mining jurisdiction. Obviously, it's an operating asset. The royalty's paying. It's operated by a major who's got about $1 billion in cash on their balance sheet from a recent asset sale, has allocated a good chunk of that to this particular operation and is expanding production. On top of that, iron ore is just behind gold in terms of best performing commodities through COVID. So it ticked quite a few boxes for us. And the returns are very healthy, and as I mentioned, it was done with the cash that we had from Trident, the original cash that was in the vehicle. So was done outside of this recent capital raise. We raised 16 million pounds when we did the AIM listing last week. So we didn't actually touch that money for this particular transaction. So by getting that royalty in the door, it just paid 540,000 Aussie for the first quarterly payment of this year. And they did quite a bit of pre-strip as well. So we expect that number likely to increase for Q2. So it will more than cover our G&A for the foreseeable future. So it was a great royalty for us to get our hands on, and I think is indicative of the kind of asset we're looking for that, as you said, relative to competitors, not in the right jurisdiction for them, not in the right commodity for them, and just too small for them. But for us, an incredibly accretive transaction.
My understanding is you got this in the secondary market. Is this something you're going to continue? Is that a strategy you want to repeat over and again, or are you going to get involved with new royalties?
We'll get involved with new royalties as well. There is certain benefits of acquiring royalties in the secondary market. Obviously, a lot of the legal legwork is done in the sense that the royalty's in place. In this case, it was linked to that specific tenement, so you don't have to go through that process. You just you sign a deed of novation to hand it over effectively. And doing new royalties, there is a bit more work up front. That said, secondary royalties, you don't always have full information rights because you're not negotiating directly with the operator. So in that case of the royalty we just picked up, we were buying it from an ASX junior who held the royalty. We weren't buying it from Mineral Resources, which is the operator of the asset. So in some senses, with secondary royalties, you can be limited with how much information you have, which for a big asset like that really isn't a huge problem, but could be for sort of smaller assets. So it's a bit of a balancing act, but long way of saying we'll look at both.
Are you? What's your pipeline like? Let's just quickly revisit the balance sheet as well. What sort of cash have you got on there? Just to repeat again what you did in terms of obviously your raising and what you spent on this iron ore project. What have you got left, and how do you expect to approach new opportunities, given the opportunities that may be down the pipe on your calendar?
Yeah, sure. So with regards to balance sheet, as I mentioned, we raised 16 million pounds, so just a touch over 20 million US. That financing then closed last week upon our AIM listing. So we've got that cash now in the bank. We've also signed a debt mandate with Tribeca, the fund out of Australia and Singapore. So it's non-binding at this stage, but we'll be advancing discussions there to get that debt formalized. So that was for 10 million US. So that gives us a lot of dry powder to go out there and continue to pick up royalties and to write new royalties. And with regards to the royalty we just acquired, so the purchase price was 4 million Aussie up front, and then 3 million in a year's time. Now that transaction closed the day after our listing, so that was June 3rd last week. That said, the royalty payment started accruing to us from January 1st, so the net was 3.45 million Aussie for the first tranche, and we'd expect for the full year we're estimating approximately 3 million Australian in royalty payments on that royalty, so should be getting very close to covering itself with regards to paying down that second and final tranche around this time next year. Obviously heavily dependent on throughput and iron ore price, but with things taking shape the way they are, we're pretty hopeful that we'd hit that number, if not exceed it.
Yeah, just talk a little bit about the opportunities you see that are coming along. I guess you can't talk about any deals that you've got up your sleeve, which could well present themselves to you. But let me just talk a little bit about whether or not you are particularly mineral specific, and of course also the geography. Are you agnostic as to where the minerals come from around the world, or are you targeting certain specific areas?
No, we're absolutely agnostic. So we'll look anywhere, and obviously we'll price in risk depending on the geography, and of course there has to be a proper legal framework for royalties, which doesn't exist in every jurisdiction. But yeah, we'll look at most jurisdictions, obviously favoring mining-friendly jurisdictions. But there's a bit of a balancing act, and obviously that you can price in that risk to a certain extent. So yeah, I think, as I mentioned, I think that sets us apart from the peers. With all of them, with one notable exception, they're all TSX listed as their primary exchange, and unsurprisingly, you overlay their royalties on a global map and very heavy North America focus, and it trickles into Central South America, and then there are sort of a smattering elsewhere. But places like Australia, for example, where we got this first royalty, obviously, prolific mining region, but no publicly listed mining royalty companies, despite the fact that there are hundreds of royalties in existence and every opportunity to write new ones. So we see some jurisdictions in particular as sort of targets of opportunity for us, but we'll be looking across the entire globe. And with regards to pipeline as well, on commodity. Sorry, go ahead.
Okay, no. Please do go on. Sorry.
Yeah, so with regards to pipeline, like you mentioned, we can't sort of speak to some of the specifics of the transactions that are ongoing. But as you'd expect, we announced our first transaction in the suspension in late March, and myself and my colleague in Perth joined Trident at the tail end of last year. So really, since that time, we've been furiously working on the pipeline. So the Cooley-Knobbing royalty that we just acquired is the first, but we had other discussions that are pretty well advanced, and really we're sort of contingent on us finalizing our listing and capital raise. So we're pretty hopeful to be able to announce some transactions in the near term over the next couple months. That will be hitting, really, hopefully all of those commodity buckets that we're targeting, so precious metals, base metals, and batteries and bulks and everything else. As I mentioned, ultimately our target is to build a portfolio that's broadly reflective of the mining sector, but obviously out of the gate, the real prerogative is to do the most accretive transactions possible and continue to build the critical mass of the portfolio, because that's how royalty companies really get value. The reason they enjoy such high valuations relative to miners is because they are a portfolio of financial instruments at the end of the day, relative to miners, which typically have a few mines in their portfolio and are more exposed to that sort of single asset risk and operational cost blowouts and that sort of thing. So it's critical for us to build mass quickly.
Just one final question. We got to wrap this up, unfortunately, because it's a fascinating discussion about this area. You currently got a market cap here in London, 21 million. You talk about the amount of money on your balance sheet. You've got a lot of cash in there with a market cap of only 21 million. Where do you see the company at the end of the year? What are you hoping to deliver to shareholders in terms of value when looking at the value of the business now and where you think it'll be, as I say, end of year and into 2021?
Yeah, so we were pretty conscious about when we did our raise, it was at 20p, which the Trident shell that was set up in 2018, which we appropriated for this purpose, it was raised at 20p. And we were very conscious about doing that. We wanted to get as many investors into the vehicle as possible. We weren't trying to capture an early uplift for ourselves or for the existing shareholders. The whole intent was we're here to build a business. And as I said, building critical mass in the portfolio is vitally important. So we didn't want to play any games on that front, which I think sets us apart from quite a few of the other groups out there. So we got in a good chunk of capital, and really for us through the remainder of the year, it's deploying that capital and fairly hopeful that we will deploy the capital over the course of this year, or at the very least have a good line of sight on where it will be deployed by the end of the year. But given the market we're in, there's no shortage of need for capital from the miners. So I think if we have an opportunity to ride a royalty over a long life, attractive asset that maybe in this market is keeping its head above water, but not much beyond that, that can be an amazing opportunity for us because you put that royalty in place, and as I said, it stays there forever. So through the good times and the bad, that royalty will be there and it'll be paying us. So a lot of opportunities coming across our desk, and pretty confident we'll be able to deploy this capital. So what that means for shareholders is obviously we're trading not much above our cash holdings at the moment, despite having formulated the strategy and brought in the management team and the board and done this first royalty, which you can do the back of the envelope calculations, very attractive sort of return profile on that particular royalty. So despite that, we are trading just above cash. So I think as we continue to go out there and do deals and spread the word about what we're doing, that is a great opportunity for investors to get in.
Yeah, look, Adam, we've got to leave it there, unfortunately, because time's beaten us. There's a ton more questions I want to ask, but let's make a promise to get back together again sometime before the end of the year when you've got some more deals to talk about. And we could talk a little bit more then about funding these new acquisitions, because it's a fascinating story. But thanks indeed for your time there from Denver. That's Adam Davidson. He's the Chief Executive of Trident Resources, soon to be renamed Trident Royalties.